Hello, Vito. This has been live streamed, so it's preparing. Fingers crossed. Fabulous, and we're live. Oh, almost live. Just need to pop myself on mute, otherwise we get that horrendous feedback. So, through the magic and power of the internet and using a complicated system of levers and pulleys, we are live on Zoom. We are live on the YouTubes. I don't think I'm technical enough to do a multiple live stream, but maybe we'll save that for next month. So, hello, Adrian, BB, Marcus, said hello to, Michael, said hello to, Suli, Vito, hello, hello. Let's get rocking and rolling. So, it's Friday. It's at the end of the quarter or the start of a new quarter. And last 6 months, if you believe the media and the headlines and the talking heads, have been horrendous. I think the reality is if when you're playing both sides of the market, it doesn't really matter what's going on. You know, whether we've got upswings, downswings, sideways movements, you know, there's always something going on. Which is great from our point of view. So anyway, we're going to dive into that a little bit more in just a moment. But as I mentioned just a moment ago, for the new people, if you're looking for swing trading the markets and anything to do with stock market swing trading related, if you want to know if to buy the dip, sell the rally, and you want to know how to find stocks, if you want to know how to get positioned on stocks, if you want to know where to set stops, set targets, you're in the right place. So let's go and do it. So I'm a firm believer that trading should be simple and it should work. It's taken me a long time to get there. Like most people, I initially made it complex, spinning plates, doing everything, indicator hopping, time frame hopping, market hopping. Basically, I was hopping mad. And we've all done it, and we've all do it at some point. I think the trick is with it is recognizing that everything works some of the time and nothing works all of the time. And I very quickly realized that. And when I had my epiphany, blockbuster video, a sunny Sunday morning, reading Jack Swagger, technical analysis for the umpteenth time. It's a tombstone of a book. It's a 1,000-page monstrosity. And at no point did it say how to trade. It just said, here's what you could do. Here's a pattern. Here's this thing. And the author did a great job, as do most authors. They do a great job of explaining what it is with hindsight. And I want to know how to make it work and make money from it. And when I had that shift in mindset to go from learning, I had all this knowledge, I'd been doing it sporadically. And that shift from, okay, well, what do I need to do to make it work? And what do I need to do to make it profitable? And there was always some missing ingredients. And for me, it was just a case of like, let's add a pullback to a breakout. Ta-da! For me personally, I started to focus on patterns and pattern recognitions, initially geometric shapes. Fast forward almost 28 years now, and I am completely rule-based. It's almost, if not completely, methodical and mechanical. So my objectives are to give you the right tools, the rules, the software to assist you, a community to support you, and a mentor, me, to show you the right way so that you get real results in the fastest and smartest possible way. I didn't have anyone to ask when I first started out. I made every mistake. I learned hard. I course corrected harder to make it work as quickly as possible because I had bills to pay, food to put on the table. For me personally, I had no backup plan. I went full time and I had to make it work as quickly as possible. Again, on a personal note, it took £1,000 or £1,000 or $1,000. So that's a £92,500 and change in 8 months when I went full time. I've been trading part time prior to that. But like I had to make it work. The sub story version is I had Crohn's disease. I was housebound for about 3 years. About 80% of the time. Initially, it was 100% of the time. I couldn't go in there, couldn't do anything. We've all had that experience. I had that back in 2001, 2002. I had nothing else to do, nowhere to go. But just like everyone else, bills to pay, food to put on the table. And I had, this gateway called the internet. So this was all brand new back then, this online trading phenomenon. So you get to benefit from like the lessons that I've learned the hard way. What I refer to now these days is I refer to what I do as production line trading. It should be like a production line. It's my way of saying an algorithm or rule based trading. And it's a simple system that is proven, profitable, repeatable, which is the key part there. It should take minimal time. For me, it takes 20 to 30 minutes a day. For my students, it might take a little bit longer because you're learning a process. But the reality is it should still just take 20 or 30 minutes a day, a few times per week. One of my primary objectives is to add a layer of detail on what most people think is correct. Buy the dip. You heard me say it before. You've heard it touted around, buy the dip. But it doesn't mean what you think it means. I saw a thing that's nothing against Jim Cramer, but Jim Cramer was talking about buying dips. I was like, we're in a bear market. There is no dip to buy. The extra layer of detail is to add a qualifier in the context of a trend. Buy the dip in the context of a trend. If you add that, then you're going to keep yourself out of trouble. Again, you still might lose a little bit of money every now and again, because I do. But the majority of the time, just adding a qualifier, what is the trend? It makes it work. I'm going to show you how I do that so it's methodical and rule-based. And then you can flip it over and you can sell the rally in a downtrend and profit from downward movements in the markets. That's what we're seeing all this year. The S&P, if you've been following along, at any point this year, we've been talking about the markets went sideways, and then it transitioned into a bearish posture. And then we've been selling rallies for at least the second quarter of this year on the S&P, and on individual stocks, we've been pretty much doing that all year. So I'm going to show you how to find a buyable dip in an uptrend. And obviously, because we're in a bear market at the moment, I'll show you the opposite, a sellable rally in a downtrend. And it's what makes it worth doing. You don't have to take my word for it. It's backed by data. At the click of a button, I can show you that it works by plugging the rules into an algorithm. That's just a fancy way of saying computer language. It's going to look back over 20 years and say, hey, if we just followed these rules, did nothing else, no subjectivity, no coulda, woulda, shoulda, no flipping coins, no cherry picking opportunities. If I just took every single trade in the last 20 years, what would have been the outcome? And then we get this equity curve, essentially. That's what a positive expectancy strategy looks like. That's an edge in the markets. And it's not complex what we do. It's just that the hard part is doing it. And that's what I hope to, again, just illustrate how I do it. Anyway, I can see everyone's coming in now. We've got lots of new faces. Hello, Brett. Welcome back. Ian. Said hello to Joseph, Marcus, Michael already. Hello, Perry. Hello, Randall. Hello, Randy. You're my friend this week. Stephen and Vito Sully as well. So we're going to look at the... we're going to spend about 60 minutes together. Just going to spend 2 minutes just introducing myself for the one or two new people who are either here today or watching it live on the YouTubes. Hello, we just started live stream, but we're going to look at sentiment timing. We're going to look at stock market sentiment. It's a non-standard way of looking at how do we pick tops, how do we pick bottoms even, how do we find turning points, how do we find opportunity that is not necessarily quantifiable. It's one of the only times that I'd like to get subjective, but the good news is it's really simple and it doesn't take any effort to look at the charts. I'll obviously show you my production line trading strategy and show you the rules that I mentioned just a moment ago. I'm also not shy to admit that there is a commercial intent warning. Again, I do this because I love doing it. I get to give back to the community as much as possible. I give the majority of what I do away for free in these open sessions. If you want to work more closely with me, you can do. It's invitation only. There is an application process. I do not work with everyone. It's not right for everyone. And if it's not right, I'll let you know, but I'll always point you off in the right direction for what you need, for what you're looking for. However, if you do want some help and support, I get people results. I know what I do works because they tell me they're getting their results, and they tell me regularly that they're profiting in the markets, even when the markets are moving fast in perceivably the opposite direction to what most people think. We can buy dips, but of course we can sell rallies. Now, it looks like everyone's here, so let's get into the meat of it. The way to get maximum value out of the session is to like, comment, ask questions. I've got both the chat boxes on in the Zoom here on the live stream and on YouTube. So if you've got a comment, pop it below. If you've got a stock that you want me to review, pop it in the chat box, pop a comment, and I'll get to it as soon as it's relevant and I see it. And once again, if you've got a question, just pop a comment. I'll always try and answer everyone's question as soon as I see it or when relevant. Before we get into it, though, a quick warning. There are no diamond hands in my commentary. I am not flying to the moon anytime soon. As I've already alluded to, I use a proven rule-based system. And basically, this prevents me from what I refer to as zombie trading. It's very easy to sit there flicking through chart after chart after chart like a mindless zombie, hoping that the next stock is doing the bunny fingers behind the camera, the one that sends you to the moon so that you can diamond hand it and all the other bullshit that people talk about. Now, the reality is 2, 3, 4, 5 hours later, you're just looking at the charts. It's just chart porn. So what I would rather do is I'd rather have a simple set of rules that allows me to avoid flicking through chart after chart, wondering if the next one is the one. Because what I never want to do is be asking myself the question, where's the trade? If you're doing that, procrastinating, just flicking through charts, going through the mental Rolodex of everything that you've read when it comes to the markets, trying to shoehorn a trading opportunity onto it, then you're doing it wrong. Where's the trade? You might as well be saying, where's Wally? Where's Waldo? You know, in a big picture of people, you know, where's Waldo? You can spend hours looking for that bugger. What we don't want to do is the stock market equivalent of where's Wally. What we do want to do is go, there's the trade. We want to go, there's that little bugger right there. We want to pop the trade on and walk away. And that using rules allows me to do that because I've quantified it to the nth degree as much as I can. I'll continue to do it. I'll continue to hone and refine what I do. Going back to our example earlier, buy the dip. That's great. Like buy the dip. Just because a stock is moving down doesn't mean it's dipping in a trend. So just adding a qualifier, adding definition on what you're looking for, what you're going to do, when you're going to do it, why you're going to do it, is going to make you a better trader. And again, fair warning, it's boring. I refer to it as a production line. And if you can imagine a factory line production line, it's boring. You're doing the same thing every single day. And we're doing the same thing every single day, every single week, every single month. For the last 28 years, I've been doing pretty much the same thing. It's boring, but it makes money. I would rather be bored and make money than be excited and lose money. So what are you doing? Are you being exciting, flicking through chart after chart, losing money hand over fist? Or do you want to make some money? So stick around. I'm going to show you how I do that. For the naysayers, I do get my results. Some examples of mine. They're past examples. Again, I call most of my trading out in real time, but quite literally yesterday, I closed a handful of trades. We've got Zillow. These are all, unsurprisingly, these are all bearish trades given the market movements. But Zillow, 65% return on capital. It's a little bit lackluster on the movements. This timed out near targets. There may be further downward movements, but I have certain rules in place. I don't know what's going to happen next. I don't know anything that will happen tomorrow with any consistency. All I know is that on average, if I follow a list of rules, then I'll make money on average over the long term. So that's what we're seeing with Zillow, 65.7% return on capital. Again, these are all closed yesterday. Broker statement is on the charts. Again, just for the naysayers. GT, 47.6% return on capital. Does it work on smaller stocks? Yes, it does. Meta, this used to be Facebook. If you didn't already know, they had a ticker change. Now this one, 22%, small profit here. It timed out. It was just taking too long to get where it's going. And the reason why that's important for me is I typically trade with stock options as an alternative to trading stock. So I have a timeout rule. When I'm going beyond my average time in trade or my average expected time in trade, then I want to get out. And this is one of those ones where it didn't quite do the thing that I was wanting to do. Etsy was something similar. We were close to targets, but this was also timing out. So it wasn't quite where I wanted it to be, but nonetheless, close enough is good enough is what I tell most of my traders. And I've got to practice what I preach. I've got to do what I say and say what I do. So it was there. It's meandered sideways for a month. There may be more in it. I don't know, but I've got a profit I'm happy with. I'm going to take it right now. Spot was the same thing. Trade was on. It went sideways. It's timed out. Small profits behind. I would say this is a break-even trade. There's nothing really to write home about. They're not all 100%, 200%, 300% winners, but, I'm just highlighting that, I've got to tidy up the portfolio as well. I can't hope that I'm going to see a big profit, but when I do, the rules are going to keep me in. We've got SLG's gone to target 141%, a classic breakout pattern. I spent 12 years just trading this pattern on day trading opportunities. It works on swing trading. It works on any time frames. It works on the bear side. Similarly, Win Resources, sell the rally in a downtrend. 111% return on capital. NXPI, this is a semiconductor stock, 61.3%. Again, not exactly a headliner return on capital, but you know what? It broke out, it moved favorably. It just didn't get there as fast as I would like it. So, about 2/3 of the way towards target. I'm happy with that. It's timed out. It may move further. I don't know. But if it sets up again, I'm going to be back in it. SQ, this is Square. We've had multiple trades on this all this year, as we have with PayPal. Again, sellable rally in a downtrend, most of the way towards targets. Didn't quite get there. But close enough is good enough. 194% return. RNG, Ring Central, 250% return on capital. Royal Caribbean, we've been following this most of this year in real time. We've had multiple back-to-back trades on this. This last one, which was a range reversal, which turned into a breakout trade, RCL. 206% return on capital. Broke statements are on the screen. BBWI, again, sell the rally in a downtrend, 263.5% return on capital. And the last one, BFH. I don't know why, but it amuses me to say bus fare home. If you're in the UK, you'll get it. If you don't, you don't. 108% return on capital. Brokers' statements are on the chart. So these are all trades that we've had quite literally closed in the last couple of weeks. They've all been open anywhere from 30 to 60 days. Having a longer term swing trade at the moment, again, just the nature of how I want to trade my own accounts. I sometimes refer to as a dial that you can turn in relation to the production line. You can speed things up or you can slow things down. I'm tending towards slowing things down and going for these bigger swings in the markets. That's a personal preference. But if you want a payout cycle that is 20, 30 days or less, you can turn that down the other way by speeding things up. You can change time frames all the way down to a 2-minute chart. If you want to day trade with the same strategy, you can do. I do it occasionally. I've had a couple of day trades, overnight swing trades. It works in exactly the same way. And again, as I've said earlier, these are my results. Again, just to try and prove to the naysayers, I've had a few negative comments this week. This is me sticking both my fingers up at you and go, screw you, here's my results. I don't need to do this. I love doing this. But just to show it to the naysayers, what's more important to me is my student results. They get their results. And I'm going to skip the who I am part. I just want to go straight into the lovely feedback that everyone sends me. These are some wonderful people, great traders, great people who have just committed to themselves to following a single process, following a simple set of rules, who get results time and time and time again. Of course, I get my results, as I mentioned, we've closed a few recently, but they get their results. And again, that's what's more important, is their success. That is what I want to do. So anyway, again, really just to prove you, again, as I mentioned earlier, this what we're going to go through today is part of a more complete process, a more complete program. I have revamped and updated it. I'm just in the process of finishing off the latest iteration of the program. On these open sessions, we touch on a very small element of the production line trading that is referred to as the mechanical elements. It should be simple. It should be work. It should allow you to follow the market process. I go through the lens that we look at in the markets every week. I'm going to show you again later, but it is part of a more complete mentorship program. And Brett's posting some very kind comments. I'm just going to read those out. To newer students, he found they used it on the 1-minute chart very successfully and swing trading, but stick with the plan. You strayed and failed and then come back to the trading plan and seeing that it works. That's awesome, Brett. That's great. You're a brand new student. And thank you very much for your, I didn't ask you to say that, so thank you very much for your kind and unsolicited words. As I mentioned, I want to give the tools, the rules, the software, a community to support you. Whether you're a mentorship student or not, you get access to the community, so you kind of get mentorship in that way as well, so that you can get results if you want them. Now, before we dip into the charts, again, a little bit of a sidebar warning. First and foremost, I chase squirrels. I can't help it. It's just how I think. Bear with me. But before we do dip into the charts, I do have just a few more minutes. I want to talk to you about something special. And this is something that it's nearest and dearest to my heart. As always, when we're talking about the media, the talking heads, the self-proclaimed gurus, and I suppose in an ironic twist, I am putting myself alongside them, but I don't pretend to be a self-proclaimed guru. I'm not taking photos in front of Lambos or jets. Like, I just want to live a quiet life, but I enjoy at the same time giving back. I'm just further along my journey is how I prefer to think about it. I'm 28 years in, I've figured it out, and I'm just trying to help you great people lift you up behind me so that you can come and stand next to me. And that's really what I'm trying to do. Anyway, the herd, thinking about that was a squirrel moment if ever I saw one. The herd is what I want to talk about. The herd is always wrong. So the herd in my case is the media, the talking heads, and specifically this week, it's about the non-financial media who then comment on financial related things, the broadsheets in old English, in the old world, the red tops, those types of non-financial media, Time Magazine, National Geographic. It's when they get involved, that's the biggest red flag for sentiment timing that you can look for. We'll look at it in big ways, we'll look at it in small ways. I'm going to spend just 5 or 10 minutes, so not that long, just before the market opens, just talking about sentiment and what it means to me and how we can use it to find big tidal shifts in the market. So the media, if you've been following me for any length of time, you'll heard me riff on this a few times. But if the media is representative of the general public, and the general public, we all know that the last to know anything, then why do we want to blindly follow or listen to the media and the talking heads? It doesn't make any sense to me. It never has done. Now, you can use them, again, you can use them to raise your awareness on something. Maybe something is going on in the media that you weren't previously aware of, and you can use that as a launching point to further investigate. But don't blindly follow. Don't blindly follow. So let me give you some examples. We can look at the current affairs. I mean, we could, why should we trust Google or Facebook or the social medias with our secrets? If I was to say this was printed last week, you'd believe me. But the reality is this is nonsense that's been talked about. I think this is 2006, this particular headline. So again, it's these news and headlines, they get recycled all the time. One of my favorites is the buy sell panic. Now, right before the 2008, the housing crisis crash, which led into the financial market crash, what we saw was the media, the headlines, Time Magazine, even National Geographic got on the bandwagon, writing articles about this is the best time to get yourself on the property ladder. Get involved, get invested in the markets. And then what we saw was the 07-08 crash. This is a good example of sentiment at its finest. They're jumping on the bandwagon, and not through any malicious intent. They're just trying to raise and jump on the shirt tails of what is very popular at the moment. It's newsworthy, and they're often talking about it as it's crashed. A recent example, well, not quite a recent example, but oil. When they're talking about the end of the oil markets, they're talking about in a negative sense. Oil is over. We're going to electric vehicles. Solar power was really coming into effect. And in 2003, that led to one of the largest bull runs at the time in oil. It was just a meteoric upward movement. We're seeing something very similar right now for different reasons. But when they're saying that the end of something is nigh, then we want to be looking 180 degrees in the opposite direction. We've seen it with crypto more recently. Again, whether you believe it, whether you love it, whether you hate it, again, I'm not quite there yet. Again, I'm not denying that crypto will be a part of everyone's future, but I just can't get past calling it a currency. It's not a currency. It may be considered an asset class, but it's not an alternative, at least not yet. But again, crypto has been talked about as far back as 2007. I remember before the crash, Facebook was talking about a digital dollar that you could get inside Facebook. You could win and earn in their on-platform games. And it was so exciting that you could then transfer it and buy things on Amazon with Facebook dollars. That was pretty cool. That was 2007. Cryptocurrency, it's not a new thing. It's Something's gone around for a while. So it will happen. It's just, we're just trying to figure out the details. Anyway, Barron's posted this article, Bitcoin storms Wall Street. If you remember, futures were issued on Bitcoin a few years ago. And what happened was that it was publicized as this is going to be amazing. Bitcoin's going to, well, look at the chart. It's going to go from 10,000 to 20, from 20 to 30, from 30 to 40. Well, we know it did do that eventually, but it crashed first. It went from 10 to cat's whisker to 20, past $20,000 a coin. And it was prior to that, we saw all of these articles saying, Bitcoin's the future, buy Bitcoin, buy Bitcoin. Does anyone remember the news articles where people were selling their homes and going and living in camper vans and in the woods so that they could buy Bitcoin? And it was right at the top of this euphoric top. I remember also hearing about, again, just the sentiment in a different way. I've got the luxury of being long time. I've got a very fortunate situation. The financial market has been able to provide me with the luxury of time. I spend most of my mornings working out and in coffee shops reading books, because that's what I want to do. That's how I want to live my life. And I remember vividly back then, I mean, this is what, 2000, I can't remember now, 2017 was it? Sitting in a coffee shop, and it was very full, mid-morning. And quite literally, as I'm walking in, people are talking about Bitcoin. I didn't quite make the connection. And then I'm queuing for the coffee and people are still talking about crypto and Bitcoin. And then I'm sat down and people are talking about Bitcoin. And then the penny dropped. It's like quite literally every table around me was talking about Bitcoin. And so we announced it on the podcast that we had. Well, we still got it, but back then it's like the top has just happened. I was just watching the market top, this euphoric climactic event where every man, woman, child, dog, cat wants to be involved. That's the top, and a pop happens. We see it time and time again. You've only got to open your eyes to look for the clues. They happen everywhere. That one, pandemic alerts, 2017. These things happen. This one's my favorite. We actually spoke about this on one of our open houses, which I wasn't doing as frequently back then, but quite literally The Economist published here's our front cover magazine. The magazine hadn't been released, but what they tend to do is post their magazine on social media. And I saw the big tech 2 trillion bull run. And I thought, holy smokes, this is the market top right here. And then the following week, about 7 to 10 days later, this was in February 2020. We know what happens. We know why it happens. But this is the market top right here. And these are examples of when the people who say, or when I say people, the financial media and talking heads, when people who are not normally engaged in the market start talking about an investment opportunity, that's the time to look 180 degrees in the opposite direction. Quick example, we need to stop listening. I put listening. Need to stop listening to bat-wielding noisemakers. But the sad part about it is that there's a grain of truth in what they're saying, and there's enough of the grain of truth for us to buy into it. Jim Cramer, again, nothing against Jim Cramer. He's just the architect of my fury when it comes to such things. He's a noisemaker, but he's so entertaining. But that's the trick. He's a financial entertainer. You might as well wear a clown suit, be juggling balls. Their objective is to get your attention, because they're selling advertising. They're just holding your attention until the ad break, because that is what they're selling. You are the product in that particular case. And if you listen to any of his or followed any of his, I'm doing the bunny fingers again, buy the dip suggestions, which is what he's talking about here, you would have lost about 75% of you would have lost 75% year to date. It was ridiculous. Why we should just blindly follow. Now, I'm not saying don't listen to what he's saying. Don't mistake and confuse what I'm trying to say. Is use it to raise your awareness if you must, and then go and investigate. Does this suggestion fit the way that I want to trade? And if the answer is yes, then you can do it. But 90% of the time, 95, 90, even 98% of the time, it probably won't fit your regular trading criteria. And there's just enough of the truth. For example, the pinch of truth is, he's quoted as, you've got to treat the ugly moments like this one as buying opportunities. And that's true. That's another way of saying buy the dip. But as we said earlier, you've got to have a trend to find a dip to buy. If there's no trend, uptrend specifically, there's no dip to buy. We're in a bear market. We have been all year. So what do we do about it? The media can be a canary in the coal mine. Our early warning signal to say, you know what, something's different, something's changed. The bird is tweeting or it stopped twittering. So we can use the non-financial media specifically to raise our awareness. They're the canary. We need to think 180 degrees, or we need to do 180 degree thinking as an anti-sentiment tool. If the herd is bullish, I want to be looking the other way. And it's human nature. And we can use it to raise awareness of a shift. Let me give you a real life example rather than just me sound like I'm crazy on a soapbox. When you go out with friends to the local pub, drinking establishments, watch, especially if it's particularly busy, but watch how everyone interacts from the door to the bar. The first thing that people do is they make a straight line move from the front door to the nearest point of the bar. And the nearest point is going to be packed, 2, 3, maybe even 4 people deep, waiting to be served. That's the crowd. That's the herd. That's the FOMO. I don't want to miss my place in the queue to be served a round of drinks. Whereas if we just, as smart traders, smart thinking, 180 degree thinking, we just step to the left and look at our environments, what you'll find is further down the bar, there is empty spaces. There may be 2, or depending on how big the establishment is, maybe 2 or 3 or 4 people. And what I used to do was, when all my friends used to go make the beeline to the bar, straight line move, I'm doing 180 degree thinking and walking down to the back of the bar where no one's being served, get served myself, and then walk back to wait in line with them with my drink because I knew it would piss them off. And until they realized that, like, just a little bit of smart thinking, just take a step to the left. You don't have to do anything crazy about it. We can do the same thing with the markets. So a pre-financial crash, pre-housing crash, Time Magazine, National Geographic, the Red Tops, the tabloids, the National Enquirer, they were all saying now's time to invest. We're seeing it now. Stocks, crypto. Anyone remember NFTs? Just 2 months ago, my barber was asking me about NFTs. My barber was asking me about NFTs. Like, nothing against him personally, but like the general public who don't normally interact or get involved with the markets, if they're asking you about the latest investments, then it's probably too late to join the party. And we're looking at a sentiment shift and the market top. I've already mentioned this one, but when your coffee barista is offering you unsolicited financial advice, or your barber, or your taxi driver, or kid on the corner, you can be sure that a top is close. And these are all examples, and this is why it makes it subjective. These are all examples of what it might look like when sentiment is at a euphoric high and a market top is in place. But Phil, everyone's talking about a market bottom. Well, the same is true with market bottoms, with a slight twist. When market tops, everyone is shouting from the rooftops, quite literally everyone, every single person is talking about the latest opportunity, the latest investments. You better get on it, otherwise you're going to miss it. But with a market bottom, it's a little bit different. There's still that loud shouting and screaming, but everyone's talking about the bottom is in, the bottom is in, the bottom is in. You know, we've got peak inflation and all the other nonsense that comes along with it. And it's almost like a comic sketch. I just quickly searched some of my favorites. I like this one on the right. You know, it's literally buy, 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 sell, 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 buy, buy, buy. And that's what we're seeing right now. Every time there's a 2% rally in the markets, which is a big move by most standards, it's probably a dead cat bounce. It's probably a sucker's rally. Everyone's got, the bottom's here. We've got a rally, rally, rally. It's buy, buy, buy. Oh, the worst is over. And the reality is it's sell, sell, sell. We've just seen that happen already. Now, we need 180 degree thinking. When we see that euphoric, the bottom's in and everyone's shouting, 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 what we need to do is think the opposite. We need to listen for the silence, because it's when people stop talking about a market bottom, they stop trying to forecast and predict and catch a falling knife. And this is the bottom. It's over. The worst is over. When that stops, that's what we're listening for. because that's when maximum pain has been reached. When the pain causes the shock and you've got quite literally silent screams. The last time we experienced it was 2020. Personally, my phone was being rang off the hook. And if people know that you look at the markets, I would imagine your phone was ringing. Hey, I know you look at the markets. What should we do? And like, it's too late to do anything if they're asking you. But when the phone stops ringing, because that's what we want to listen. That's the silence. And we can find that silence in a lot of different ways. When the phone stops ringing, the bottom is probably in. And that's when we can start looking for the capitulation signs. That's when we can start looking for fundamental triggers, the usual clues and footprints that are inherent in every turning point, be either charting or fundamental or whatever your thing is. But there's no point stressing and trying to crystal ball predict. We just need to look for clues. We can look at the most recent one, the dot-com bubble. We've been doing that the last few weeks. Certainly we did it last week as well, where we looked back at the charts and say, well, what does a bottom look like? What does it look like? And we're going to look for similar shapes, chart-based patterns for that. But we can look back to the dot-com bubble and the bear market that came afterwards. We can look for currency strength associated with equity strength and outperformance. That's what led into the dot-com bubble. We saw that this time as well. We've got currency strength, equity outperformance. You saw that in the dot-com 95, 2002. We've seen that right now for, again, a variety of different reasons. But now we've got that sell-off. We can look for the chart-based patterns. We've yet to see earnings downgrades. We've yet to see the bear really growl. We've yet to see my phone ring off the hook, your phone ring off the hook. People who want to know, what should we do? What should we do? What should we do? My 401k is gone or is halved. I'm going to have to extend my retirement date. I'm going to have to work in my retirement. I'm going to have to get pot. We're going to see all of those things. These are normal things in bear markets. When that happens, we can start to take time out and start to look for these basing patterns. We've looked at examples last week in the 2002 bottom that led to the subsequent rallies. And turns take time. Turns take time. We can see, as we looked at last week, the week before, and the week before that, when we looked at the chart version of what a bottom looks like. But they can take anywhere, well, as little as 3 months, but usually between 6 and 8 months to stabilize. And then we see the turn. Then we see the average prices crossover, our usual mechanical factor to start buying on new instruments. But it all starts with the silence, when people are stopping screaming about for market bottoms. And then that's when we can go, there's the trade. There is the trade. That's what we're looking for. Right, that's it, folks. Rant over. Before we go and nerd on some charts, I just want to get some feedback. Like, what are your thoughts on that? Does that land? Does it make sense? Like, leave me a comment and just let me know your thoughts on market sentiment. Does that resonate? Because this is one of the more subjective things that I go through. It's not the same every time, which makes it subjective, but you get the, if you'll pardon the double point, the sentiment of what we're looking for. It's the, when everyone's looking in one direction, we want to be facing in the other and be ready to run in the other direction. So always do the opposite, never go with the herd. So how does that land? Does that resonate with you folks? Awesome, James. Thank you very much. Thank you very much, Randy. Catching up on the comments as well while I'm doing that. Awesome. I don't think I've missed any questions. Cool, cool, cool. I've got your Tigger's breath. We'll look at those in a moment. Awesome. Thanks for your comment, Zeke. Thank you, Michael. Perfect. Right. Well, in that case, then, if there's no questions on it, let's go nerd out on the charts. Here we go, trade station. All right there. So the markets have just opened. No big shakes. So as we, I think there's one or two new people. I'm going to give the quick version of what we do, just so that we've got a frame of reference. So just bear with me for 60 seconds. I'll give the very quick version. I've got longer explanations of the framework that I use to find Bible dips and sellable rallies. It is on past recordings. So if you want a more detailed overview, please go and visit the YouTube channel. There's plenty of examples, but just so that you're up to speed today with one or two new people. One of the things that are, one of the tools that I use, firstly, we're on a daily chart. This is the S&P futures. And I've got 3 lines on my chart. I've got the 200, I've got the 50, and I've got the 20-period moving average. There is nothing magical about these indicators. They are simple moving averages. I'm not using anything weird. It just allows me a mechanical frame of reference. And all I'm looking to do is say, where's price in relation to the average prices? I'm also going to bias myself with the crossover. So when the 50 period is above the 200, I'm going to bias myself to the bullish side. Conversely, when the other happens, when the 50 is below the 200, I'm going to bias myself to the bearish side. It's super simple, but it just gives you a directional bias, well, to be biased against. Now, what that means is that I can then be looking for buyable dips in the context of an uptrend and sellable rallies in the context of a downtrend. Now, just for simplicity, let's just focus on the 200 and the 50. I do use all 3 moving averages, but again, just for simplicity, let's just focus on the 200 and the 50. So what I'm looking for is for price to come between the 50 and the 200 period moving average. And conversely, for bear movements, sellable rallies between the 50 and the 200 on the downside. So that's what I'm looking for. So this means that when it touches the 50 period moving average, these are all buyable dips. They're all buyable dips. So what I'm looking for is for price to come back to or between the averages. That is my criteria to say, you know what, this is a buyable dip. Great. So when it pushes back away from the moving averages and back above the 50 or back above the 20, that's my buying opportunity because I want to profit from the upward swing in the markets. Now, if I plug those rules into my algorithm, it fires off trades automatically for me. I generally just use this for validation. I don't actually auto trade for reference. I know people who do. I'm personally not there. But what we can see is I'm just highlighting the times where it lost money. So it doesn't always work, but I'm also going to highlight the times that it does work. We can see that it works more than it loses. So what we're looking for is an on average profit over a long period of time over multiple occurrences. Let's put it into a different context. I'm going to start a business on the high streets. I'm going to specialize in women's shoes. And I'm going to buy a couple of varieties with the most common shoe sizes. I'm going to advertise my business. I'm going to be open for business 9 to 5. And I'm going to sell the shoes on the high streets. Sometimes a customer's going to come in and say, can I have a refund? Because they don't quite fit properly or the heel's broken or there's bad quality. Most of the time that's going to happen. But then someone's going to come in and buy a pair of shoes that they like and buy a pair of shoes that they like. And maybe someone comes in and buys 2 pairs of shoes that they like. And maybe someone comes in and buys 3 pairs of shoes because they really like them. It's the birthday. You see what I mean? Like all we're doing is the same practices that we take for granted in the real world. You've got a realistic expectation of what a business looks like in the real world. All we're doing is the stock market equivalent. I'm looking for a realistic on average return over multiple trades. So if I plug those rules into the computer, which I have done, it fires off some trades. And I say to the computer, hey, if I just trade that way for the last 20 years and I do nothing else, no subjectivity, I just take every trade as it's supposed to, it plots a nice little equity curve for me. So if I put, just for example, $1,000 in on every trade, it's non-compounded. The number doesn't really matter. It just gives a benchmark for non-compounded returns. This is what a steady equity curve looks like. This is what a positive expectancy looks like. Again, all I'm trying to do is demonstrate that it works. It works regularly. So specifically, it works on this market, on the S&P 500. So what I can do is I can confidently place the trade and know that if I take the trades with the frequency that they set up, then I should emulate this performance. I can't guarantee that you'll get the same performance as the algo. It doesn't work that way. But what I'm looking to do is emulate the positive expectancy performance. That's what I'm looking to do. So I follow this on a group of stocks. So with that said, let's look at the bear side of the market. So the S&P right now, we've got that bearish posture. There's the 50, there's the 200. So we've got a bearish posture in the markets. So you're looking to sell the rallies, sell the rallies, sell the rallies. Where's the dip to buy? If you believe the media, where is the dip to buy? Where's the dip? There isn't one. Doesn't mean there's no dip to buy. There's just no dip on the S&P to buy right now. What we're looking for is sellable rallies. Now, we can find buying opportunities. SQM, for example, doesn't mean that there's no bull movements. For every bull, because the way that I like to trade is I like to trade a portfolio style approach. So there are bullish opportunities. So we've got a lovely trend. There's our trend. 50 and the 200. So we've got 200 there, we've got 50 there. Great. So the average prices are up. We can find buyable dips. We've got rallies, we've got dips. These are buyable dips. So what we're waiting for is for price to push back above our average prices to suggest that price is resuming its upward movements. Now that's rally in a downtrend on the S&P should create this upward swing in the markets on the bullish stocks. The downward movements in the S&P is going to create the bearish swing on stocks that are in a downtrend. So we can still play both sides of the market. I've never subscribed to the fact that if the market is bearish, I should only be bearish. If the market is bullish, I should only be bullish. The way I like to trade is have a balanced portfolio from a directional viewpoint on a small group of proven winners. So the next thing to kind of make this work is I want to have a balance of bullish trades and bearish trades. Again, I typically start all my traders off with their top 25. And Perry, I've just seen, I think he's popped a comment in the chat box. Perry's just closed BBWI. So we're looking at this chart. This is one of our sell the rallies. Average price crossed over, sell the rally. You can get in there, you can get in there. There's two possible choices. And we've got a lovely two target move. It's gone from $50 approximately down to, again, a cat's whisker above 25. The stock's halved. And there's plenty of opportunity within that move to get involved. So well done, Perry. Well done. I think you outperformed. I think I got 260 something on BBWI. So very well done. Excellent. You've outperformed me. I'm jealous. Anyway, the point is it's a sellable rally. So as I said before, I don't know which trade's going to work. I only know that it works on average. So what I've got to do is I've got to trade around about 25 stocks. Again, you can trade more. I don't recommend less. But what I can do is I can trade a group of proven winners. So I run all the stocks that I like to look at that have high liquidity. They've got stock options. I run them all through the algo. And I come up with a group of stocks that I like and then a group of favorites that I only trade. So I'm not trying to cherry pick. I'm not trying to bounce around from stock to stock, from market to market, from time frame to time frame, the zombie trading. I've got 25 stocks. They're on my production line. And all I'm waiting for is for them to go from the raw materials, the holding area, essentially. Wait for them to go back into a sellable rally. Great. That's where we've got to be involved in the market. Again, we don't know if this is the one that's going to work. We do know that they will work on average. Some of them will work, some of them won't work. So I've got to trade with the frequency that these trades set up without cherry picking. Because as soon as you start to try and cherry pick what you think might be the best one, well, inevitably, that's going to be the one that is, well, as Perry's just said, that's the one that's going to be the 300% return on capital, because you try to cherry pick. Oh, this doesn't look like a great setup. Oh, this doesn't look great. How do you know that? I don't know what's going to happen tomorrow any more than you do. But what we have to do is to trade the setups with the frequency that they set up. So you're going to have a number of bullish trades. And at the moment, the markets has been sell off. So I've got a number of bullish trades that are underperforming. I've got a number of bearish trades that are going, yeehaw. And you've just seen the results. Most of these bearish trades have been closed out. Not all of them. Some of them are underperforming as well. But we don't know which ones are going to work or when they will work. For example, NXPI, we recently closed this trade. You saw the results, and you saw the broker statement before. The initial trade was on the breakout. And what happened was it then did that for the next 1 to 2 months. Now, I didn't know that that was going to happen, but you know what keeps me sane is I can use a stock option. I'm not going to get stopped out of my trade, but it will time out, because the way that I use an option is to use it as an alternative to trading stock. And now what that means is I can buy a put on the market. For every put, I can control 100 shares at a discount. Effectively, I can place a deposit and reserve 100 shares. And if the stock moves down, then I can sell my deposit back to the market for a profit. That's pretty cool. And what it means then is if I'm playing with fixed deposits, there's fixed risk, I can buy my puts here in the usual way. And I can only say with hindsight that it messed me around. But because the price of the option is fixed, I physically can't lose any more than the price of the option. So I'm going to use the full price of the option as my built-in, firstly, risk control. And then I've also got a time stop loss. If in the time that I've purchased, it's not working out, I'm going to close the trade. And it means that you can sit through the bullshit. And then when it moves, you can profit quite confidently. So this is what's happening on the bullish side. They're underperforming. They're not working great. That's fine. The retracements on the bullish stocks are going to be small because they're in an uptrend, but the downswings will profit when they profit. So we've got a nice way to profit from up and down swings in any environment, because there's going to be bullish stocks, there's going to be bearish stocks. There's a little bit more bearish stocks at the moment for obvious reasons, but there's always going to be some bullish opportunities as well as bearish opportunities. And this means that I've got some bullish stocks in my top 25 stocks, some bearish stocks in my top 25 stocks. And then some of them are just going to be on the sidelines. Like I've just closed several, so there's many that are on the sidelines. I'm waiting for rallies in downtrends now. But it doesn't matter if we have an upswing or a downswing. It doesn't matter if the Fed decides to turn the machines back on and suddenly trillions of dollars gets pumped into the markets. I've got some bullish exposure. It was previously underperforming. Now it's overperforming. We've just seen this in the energy sector. And what have we got? Halliburton. We've got LNG. Halliburton, LNG. We've had some great trades on LNG for the same reason. Again, while the bear market's been going down all year, energy sector's been going up. That's great. That's what we want to happen. Halliburton, we've had great stocks. Again, while the bear has been growling, we've had some great bullish opportunities. This is one of the stocks that we've been tracking here on the open house sessions. I had multiple trades. And again, we're right back to the 200 right here. We need to see it go back above the 50-period moving average. So it's not an immediate buying opportunity, but we're just waiting for it to resume its bullish posture. Right now, it's in the holding area. It's potentially providing a good opportunity. It's just not ready to fire off a trade just yet. One that we were looking at last week and the week before on the bearish side, let me take a look at that for you, VLO, is CRISPR Therapeutics. This is one of my speculative stocks. The only reason why it's speculative is I've not got a 20-year back history for this, but it's clear that we're in a downtrend. Visually, we can see it. The average prices are splayed apart. We got sellable rally. Now we've got another sellable rally. A little bit of and then you can, if you want to, you can layer on the discretionary stuff. I'm a pattern guy. I think this jumps off the chart at me. You've got this contraction in price. Waiting for it to go back below the 50. When it does, if it does, I can get positions. If it goes up, I won't be trading it, at least not yet. But this compressed pattern, it often leads to explosive moves. This could be an interesting setup. Again, we mentioned it last week, just waiting for it to trigger. The trigger being the yellow line. So below, for me, around $56.35. That's what I'm waiting for to happen. That will trigger me in the trade. And then I can move it along the production line. I can move it from the holding pen. I can move it into the open positions. Then I can start applying the management production line. And it's basically just waiting for profits. So we've got lots of good choices here. So let's go through this top 25. Let's see what we can find in the last few minutes. In fact, let me go to some of the tickers first. So VLO was one that James was looking at. So VLO, VLVLVLO. Sounds like a song, doesn't it? Again, lovely consolidation. One of our money-making patterns. Breakout, pullback. Lovely move. This was my, what was it, 1,200%? return. This was like one of my personal best trades. I completely forgot about this. One of my personal best trades. So yeah, very happy with this. But nonetheless, we've got multiple opportunities to buy the dip in a candidate. Again, they're not all going to work. That last one, well, it's a buyable dip, but it's not being bought yet. And if you did, it's just the way it is. You've got 1, 2, 3, 4 trade opportunities, and one of them's not going to work. So you've got 4 out of 5 trades, potentially not working. I think I'd be okay with 4 out of 5. I think I'd be okay with 4 out of 5. So this is what I keep saying. It's an on average return. If you're hoping for the one trade to work, you're a zombie trader. If you're looking for chart after chart, hoping to find something, hopping around like a bouncing gummy bear, you're doing it wrong. We want to be more like, instead of hunters and going hunting for opportunities, we want to be more like farmers. I'm just sat here on the sidelines, reading my book, farming on my production line for the best opportunities from my universe of stocks. In this case, it's 25. I am not looking at anything else. Nothing else is catching my attention. I want to emulate the strategy performance on stocks that make sense. And just a little bit of a sidebar, if you've got a small account, you can do this on a small account. Firstly, you're not trading stock. I suggest people trade with stock options as an alternative. So it's not capital intensive. If single options are still too expensive because of the volatility at the moment, everything's a little bit more costly, then you can trade debit spreads. And you can make that trade affordable for any account size, whether you're a big account trader or a small account trader. It doesn't make any difference to how we place trades. So you can trade a portfolio and start beating Wall Street at their own game. The banks, the hedge funds, the institutions, the pension funds, they trade portfolios. The beautiful thing about what changed in 2009 with the regulations is there are margin-free requirements for long options. If I have $100 option, it costs me $100. My margin is $100. My price is $100. It's not costing me anything else than $100. Again, it could be 50, it could be 10, it could be 1,000, it could be 3, whatever your number is per trade. It's affordable. So don't be put off by something new. What we want to do is make money from the markets. We need to open our shop. We've got 25 products on the shelf that are available for customers to purchase. Again, I'm using a real world metaphor. You get what I'm saying, don't you, guys and girls? You get what I'm saying. We're not doing anything different. We're going to specialize on our shoes on the high street, on the main streets. We've got 25 varieties in all the sizes that we want. Great. We're just waiting for a customer to come in. We're waiting for a setup to happen. And maybe it walks out the door. Maybe it runs out the door. And it buys 2, 3, 4, 5 varieties and lots of different sizes. We get the 10 bagger. Occasionally it's going to stop out. Occasionally it's going to come back for a refund. That's okay. That's how every business works. Stock market equivalent of a proven business model. Sorry, I can't find myself riffing again. Hopefully you at least find some entertainment. So let's go back to Brett's XLRE, some ETFs there. So from Brett, XLRE, XLF, and XLE. So we've got some interesting things here. So the first thing I'm always going to do is whenever you're looking at the charts is, okay, we've got the average price crossover. We're in a mechanical bearish posture. But what I can also see is we've got multiple crosses in our average price all around that same horizontal level. Can everyone see that, first of all? While I've got a mechanical bearish posture in the last 2, 3, 4, 6 months. So the only reason why that happens is because price is ranging. Again, don't worry about the name of it. Okay, note visually trending. The averages are stacked, separated from each other. So that's what trending looks like. And with ranging is when one or more of the averages are flipping and are flopping around either the same price points or very, they're bunched up in time. Don't worry about the name of it. You can come up with whatever fancy name that you want afterwards. You can call it Head and Shoulders. You can call it a dinosaur. You can call it a giraffe. You can call it a Gartley. I don't care. Just draw a big box around where price is consolidating. Great. Now what we're waiting for is in this case, price to break out. Now, in this case, you've got the average prices start to separate and the breakouts. So you can pretty much resort quite quickly back to the mechanical trend. But you want to trade the first pullback after the breakout. There's a pullback. The mechanical trend trading pattern also sets up at the same time. There's the big sell-off. So there's the push. There's the first profit. So if you weren't sure about the breakout the first time, you've got the first push. You've got another pullback back to the 20. Prices back to the 20-period moving average. It's pushing away from the 20-period moving average. Cool. If it gets back to the 50, we can look for a new trade there as well. So you've got a lovely sellable rally in a downtrend. That's perfect pick there, James. Oh, my apologies. Perfect pick, Brett. So James asking a question. So XLF. Now you don't have to do the evaluation for a consolidation. The algo says sell the rally in downtrends. Sell the rally at the 20 or the 50. Sell the rally in downtrend. If you want to be mechanical, that's cool. But if you see other patterns as well, you can layer it on top. Well, the sell the rally in a downtrend is below the consolidation. Okay, so we don't have to worry about that consolidation anymore. It's been and gone with. Okay, cool. That's how I deal with it. And then the last one, so sell the rally in a downtrend on XLF. And what's one more? XLE, the energy sector. What do you think? Now you know the secrets. Is it buy the dip or sell the rally? Brett, is it buy the dip or sell the rally? Yeah, yes, yeah, it's both. It's buy the dip, but wait. So it's clearly going up. We've clearly got a Bible dip. There's the 200. There's the 50. So what you're waiting for is for price to push back above the 50-period moving average. It's not no, it's just not today. So you put that in a hold. So what I would do with this is I'll put it in a holding pen. So on my trade station, I've got a little bit of space there. I've got my top 25, and then I've got stocks that I'm watching. So these go into a watch list. So what I would do is, okay, XLE, it's a Bible dip in the context of a trend. It doesn't mean automatically buy it. I'm going to bump it to the top of my list. Now, this is going to be the first thing that I look at tomorrow. Is XLE above the 50-period moving average? If no, come back tomorrow. If yes, place the trade. Pretty cool. Right, let's quickly do a round robin. Now, I've got the watch list version of all the tools here. So this column here, this is letting me know that these stocks are in a bearish posture and these stocks are in a bullish posture because of the trend indicator. So what I've done is I've had the trend indication right there. Basically, all the average prices crossed over. So these stocks are bullish, and these stocks are all in a bearish posture. Cool. So out of your 25, you've got some stocks that are bullish, some stocks that are bearish. Now, there's a couple that are bullish and bearish, but it's probably not worth trading. I won't go into that just right now. Most of my lovely students already know what we're looking for on that regard. But what I can also do is go through and see if there's any Bible dips or sellable rates. Now, the market's just sold off. So all the bear candidates are starting to push lower. But we've just had a brand new quick tip, actually, while we're looking through. Whenever you're looking at the charts, make sure that you've got around about 12 months in view. We're going to run a little bit over today, folks. Just bear with me. Look at around about 12 months in view. Look at around about 12 months. Because it means that you get to see the trend or the consolidation or the change of trend. So this is done a little bit of all three. So it just gives you a view, a perspective. What you don't want to do is do that. Like, that's not telling you anything. It might be going up. It might be going down. I can't tell. Make it easy. Press the easy button. We need to have enough data in view so that we can one time. So looking at more data means that I can one time frame. You'll notice I'm not doing a top-down approach. It's bullshit. I'm not messing around going from daily to weekly to monthly to 60-minute chart, 5-minute entry. Oh, bollocks, I'm zombie trading. I want a one time frame. I want to go, there's the trade. So how do we do there's the trade? Make sure you look at 12 months. Now, right, now we can do it. Let's go down the bearish candidates. Is there anything for me on the bear side? Well, Apple's just set up a brand new sellable rally. That's set up early in the week for me. The trade's on. There's no action for me to take. Amazon, sellable rally. It's set up early in the week. It's in a bearish posture. Sell the rally in a downtrend. Now you know the secret. Can you see how quick it is? Even if you've got to go through manually, now you know the secrets. It's in a bearish posture. Average prices are crossed down. Price are between the first two moving averages. Sell the rally in a downtrend. Great. Is the trade on? Yes. Okay. There's no action for me to take. Ring Central. Ring Central. We're in a, visually we can see it. We've got a mechanical bearish posture. We've got multiple rallies in a downtrend. And this has been very kind to us. And we've just closed the trade on this. We've just closed the trade on on Ring Central, on ISRG as well, and Ring Central. So yeah, I've just closed out. It's taken a little bit too long to get any further, but nonetheless, you've got a sellable rally in a downtrend. SPY. We've just had a sellable rally in a downtrend. AMAT. We've just had a breakout. We've just had a sellable rally. It's just reached target. I've just closed the trade on this. So I'm waiting for a rally in a downtrend. AMD. Sell the rally in a downtrend. Does everyone get this? This is simple. Now you know the secret. Sell the rally in a downtrend. BBWI, we've just closed the trade on this, 260 odd percent or whatever it was. It's gone from $50 down to $25. Sell the rally. I'm waiting for a sellable rally in a downtrend. BFH, guess what? Just had a trade on this. I've just shown you a profitable trade on this. It's ran to its conclusion. It's ran to its targets. I'm now waiting for a sellable rally in a downtrend. There's no action to take. Close the trade, take profits if you're already in. Jefferies Financial, bane of my life. It's been a bugger while it's turning around. But guess what? Sell the rally in a downtrend. Marvell, MRVL. Guess what? Can you see it? Sell the rally. I never sell the rally. NXP, I've just closed the trade on this. Sell the rally. SIG, Signet Jewelers. Sell the rally. It's a new early stage downtrend. Very cool. SLG, I've just closed the trade on this yesterday. You saw the broker statements earlier. Breakout of a consolidation. One of the 6 money making patterns. First pullback after the breakout, it then collapsed. I wish that they were all this fast. I really do. They're not. What happens to the losses? As I mentioned earlier, losses for me get deferred to expiration. So a question from the room, what happens to losses? Losses get deferred to expiration. I use the full price of my option premium as my built-in risk control. This means that I don't have to spend any effort or bandwidth stressing over stop losses, stressing over the markets. It's taken care of. The downside is that loss gets deferred to expiration. Means that I can focus on trades. I can focus on profits. I can focus on managing winners. Real world example. Do you want to keep hiring the member of staff that's stealing from you? No, you're going to fire that bastard. So the way we do it in the optional is we have the full price of the premium as a built-in stop loss, and we have an expiration date. On the expiration date, it gets fired. It's not working. It's a market refund, but I'm not losing any sleep over it because this should be a fixed, acceptable, defined loss. So they're the bullish trades. Sell them. We're either selling rallies, early stage, like Apple, Amazon, IRSG. The rest I've just closed to a profitable conclusion. So I've got 2 or 3 bearish trades on at the moment. Baidu, just in the interest of being open and honest, Baidu is kicking me in the shins. They don't all work out. Breakouts, just like we saw with some of the other trades, it's doing this rising channel. Now I'm still bearish on this. I'm sitting through a retracement. My risk is fixed. It could go all the way up here. It doesn't matter how bad or how wrong I am. My risk is defined on the entry. That's the wonderful thing about an option. But I have the kicker. What if I'm right and I just mistime the entry? And I love this. What if I'm right and I just mistime the entry and Baidu collapses? I'm going to profit from the trade that I planned anyway. But with the benefit of hindsight, it was clear that I mistimed my entry. But what I know on average is that on average, I'm going to emulate or hopefully outperform. Now, the algo is based on stocks. So the algo fired off a trade. There's the trade. It's got the dotted line and the thing and all the stuff that it codes up. So by using an option, I'm outperforming the algo because I'm not taking that loss, at least not yet. But if it sets up again and stops out and sets up again and stops out and it does something messy, then I'm going to outperform the algo just by using a smart choice of trade management. Again, just to illustrate that they're not all working. SQM, buy the dip, waiting for the rally. ABC, it's easy as waiting for the rally. All states. For me, I think this is in a range. We've got multiple crosses in the average price. I've attempted, again, just in the interest of disclosure, I've attempted one bullish trade up here on the breakouts. Didn't work. That's cool. I've got a chance because enough time's passed. I've got a chance at managing this for a reduced loss or a break-even trade. I don't know if I'll get it, but it's not going to hurt me. I get all the way to expiration to manage the trade more effectively. It's cool. I like that. Gives me a peace of mind. And if it does take off like a rocket and we can diamond hand it and it does go to the moon and all the other bullshit, if it does take off, because it has proven it can take off. If it does that, I get a shot at a break-even trade. I don't have to take the loss. And this is a wonderful place to be. Last couple for the bullish side. Again, it's going sideways. Multiple crosses in the average price right there. If you're looking for a brand new trade, wait for the breakouts. Wait for the breakouts. Don't make it. Just draw a box around it. Don't worry about trying to label it. Don't go, it looks like a Head and Shoulders wizard wig bang. Who cares? It's contracting. Draw a box around it. Wait for the breakouts. COP. Buy the dip. Waiting for price to go back above the 50. It's not no. It's just not today. Most of the energy stocks like this actually. CVX is going to be similar. Buy the dip. It is a Bible dip, but it's not an automatic buy the dip like some of the pundits keep saying. You've got to wait for confirmation. Confirmation in this case is when price pushes above the average prices. Great, I'm going to get involved. It's now back in a bullish posture. Last one, and then we'll wrap up. HPQ, guess what? It's in a range. It might be changing direction. It's breaking down. The average prices are pointing upwards. They're getting close together here. So we may be looking at a change of direction on HPQ. Okay, we'll find out. Don't have to trade it. Just wait for one of the 6 patterns. This is what I mean by farming. I've got 6 well-defined trading patterns. The majority of the time, it's the first 2. Buy the dip, sell the rally. I'm just waiting. I'm farming. I'm just waiting for the chance to say, oh, there's a buyable dip. Oh, there's a sellable rally. Oh, there's a breakout. Oh, there's this. Whatever the patterns that you want to use. You want to farm the setups. I want to farm them on a small group of proven winners and just wait for the setups. Wait for the setups. Right, folks. Woof, we got there. We got there together, more importantly. Right, what was your, before we wrap things up, firstly, thank you for your time and attention and the additional time that we ran over. But what was your biggest takeaway today? What was your aha? Was there something that just slotted into place that just gave you an epiphany? Where you're at, what was the moments that you just thought, what, that was a writer downer? Let me know what you think. There we go. Perry's just saying BBWI 300. Well done, mate. Well done. So what was your biggest takeaway? Awesome, Perry. Thank you for your kind words. I like defining the definedness. Awesome. New comment from Michael. We've got learning when to buy the dips and sell the rallies. Yeah, I mean, for most people, it's as simple as it gets, just adding that extra layer of definition. I think that's really a big, certainly for me, that was a breakthrough moment. Like, oh yeah, I want to buy the dip. Like everyone says, buy the dip. Like, how do you do it? How do you just tell me how? Like, I know I've got to buy the dip. Just tell me how it's done. That's the bit that no one tells you. Awesome. Lots of comments today. We've got Zeke, forget the news, trust the plan. Trust the plan. Have a plan. Patience is the key. What's that? I need to get my eyes checked. They don't all do it like they do in the movies. Awesome. I think that's it. Thank you again all for your kind words and comments. As always, thank you from the bottom of my heart. I try never to take it for granted that we could all be doing something else with our time, me included. I could be doing something else as well. I truly get a lot out of it. I enjoy trying to give back to the community. That you've spent a moment of your time with me here today, I really appreciate it. So thank you very much. And the last thing from James, actually, the 180-degree thinking concept. Yeah, I was giving that some thought this morning. So that phrase just popped into my mind. Anyway, if I could just ask you to do one thing for me, it would just be to do it. I never had anyone to ask or guide me. I had to make every mistake that could be made. I didn't realize there was people out there. The internet was brand new. The channels of communication are wide open these days. You can pretty much ask anyone anywhere for some help. But you've got everything that I do, at least the back of the envelope version of what I do. There are a little bit, some extra specifics that make it a little bit smoother. But nonetheless, I just hope and wish that you all do it. If you would like to work more closely with me, that is an invitation. You are invited. You can just click reply on any of the emails that you receive from me, or if you're in the Slack community, that's usually where I hang out. I've got a Slack channel. The link is in most of the emails. You can just click on my name, click on me direct. I'm pretty responsive most of the time. There's a few exceptions, obviously, when I'm doing something else. But if you'd like to talk more about it and see if it's right for you, then that's cool. And if it's not, that's okay as well. I'll always point you off in the right direction, but at least you will go away a more educated and informed person so that you can ask the next person a smarter and more informed question. As always, my objective as a mentor is to give the right tools, the rules, the software to assist you, the community, and to be a mentor to show you the way. I never had anyone to show me, but if I can speed up your journey, that would be awesome so that you can get real results right now. The full process is, despite you thinking I've given away the farm, it's just a small part of what I do to help you. There's a lot more to it. It's a lot of intangibles that make it work because it's not easy what we do. It's a learned skill, and you can learn what we do in an afternoon. The exact step-by-step rules, you can probably learn them in about 45 minutes, but then putting them into practice is the hard part, and that's what people get wrong. So I help people measure, review, and grow as a trader, and then help master the mind over the markets. I never thought I'd catch myself shaking beads and hugging trees when it comes to mindsets. I still don't to this day, but mindset is a big part of why I'm still doing this 28 years later. Most people give up at some point. So it's my hope that I can help you over that hurdle so that you don't give up and you can continue applying the mechanical system. And again, I've just shown you a part of it today. So if you want to talk, then that's great. If you just want to ask a few questions or be pointed off in the right direction, that's cool as well. So I think that's it. Let's land the plane and let's press the game over button. If you've got any questions, comments, observations, again, same thing. If I've missed your question, it was not intentional. Just shoot me an email or pop me a message on Slack, and I will get to it when I see it. Absolutely, Perry. As always, make sure that ice cream is involved in your immediate future. Wherever you are in the world, there's nothing quite like a little bit of a chalk ice. So yes, something sweet to make the weekend go by. What are you up to this weekend? If you're still sticking around and you want a little bit of banter, that's cool. I'm off to the theatre tomorrow, doing something also tonight with my lovely wife. That sounded a little bit rude. We're just catching up with Stranger Things, which I'm really enjoying at the moment. Michael, great to have you here. Zeke, wonderful. Randy, awesome. Right, let's do it then. If there's no further questions, I will see you inside the community. Have a great weekend, folks. Toodaloo and a ta-ra for now.